Welcome back. My name is Arya, and I don't waste your time. So let's get straight into it. Ladies and gentlemen, in investing, things don't always have to be hard. Oftentimes I hear from investors that, with Starbucks, things are going to improve. Brian Nicole's coming in as the new CEO, and things are going to change. They're going to turn it around. The China expansion, this and that. There's too many working parts, frankly, going on in the story of a business. Or, for example, a stock like PayPal that I also used to own once upon a time. Again, brand new CEO coming in, all these different buybacks they're doing. They're going to be able to re-accelerate growth, among a slew of other things. Another example that many investors have been kind of sitting twiddling their thumbs over is the various different REIT companies. You got Vici Properties, Realty Income, and various many other companies that, due to the interest rates, the dividend yield that those investments offer are less attractive compared to what you could make risk-free investing in even something as simple as a high-yield savings account. And so I sit here before you today and tell you that sometimes in investing, it doesn't really matter the complexity of your thesis with a business. You could just own the most immediately cash-generative business of all time, and you could buy it 20 years after its initial public offering, and you're probably still going to have a wonderful result and probably outperform the market. Ladies and gentlemen, if you haven't figured it out yet, the stock that we're going to be talking about today is, in fact, Alphabet, or the Google parent. YouTube's, of course, under that, which is what you're watching the video on. I'm not going to sit here and rave about how great of a business Alphabet or Google is. There's many other videos going more in depth into the specific parts of Google. Instead, this video is operating under the belief that you have accepted that Alphabet is an incredible business. And so instead, I'm going to prove to you throughout this video why it is a business that is just completely mispriced, and that the risk factors that have led to this mispricing aren't that serious. So without further ado, what you're looking at in front of you right now is the forward PE ratio of Google over the past 10 years. And as you can see, that it has bottomed in the roughly 16 or maybe around 15 PE range in January of 2021 and 2023 respectively. And so just off first glance, we're actually like coming up pretty close to the literal bottom in terms of forward PE ratio for this business. And particularly another way that I could show you the undervaluation on this is by toggling on the average PE ratio. So this essentially takes every single data point, averages out, and you can see that Google has typically traded at an average of 23.5 forward PE ratio over the past decade, and that is quite a meaningful jump from where the current PE ratio of this business is. Now, of course, some of you and even myself, I do like to look at the free cash flows of the business, and admittedly, if you look at the free cash flows on a surface level, they don't look as good. It's right about an average of where it's been in the past decade, but this is a little bit misleading because of extensive amounts of capital expenditure that Google has actually done in the recent couple quarters, and I'll be able to demonstrate that later on in the video. With that in mind, what is the reason to the sell-off? Now, I actually tackled this in the portfolio update that I always pin at the top of my Twitter page. It's always going to be there if you're curious to see what I've been buying and selling. So I bumped up my stake in Google. I did sell Paycom, which was a very briefly held business. You could read the portfolio update if you're really interested in the details on that. But I see online, and particularly on Twitter, that it comes down to two different complaints with Google. Number one is that there's a cohort of people that are just completely convinced over the fact that ChatGPT, for certain, it is going to disrupt Google and it's going to completely take it over. It is able to provide more accurate results. And so the technological leadership that it has over Google, it's certain it's going to happen, right? And of course, I'm not going to sit here and tell you like, no, that's a non-risk. There's a 0% chance. Of course, there's a chance of that happening. But furthermore, I think the risk is a little bit overdone. I think for starters, Google has built up over the past 25 years, give or take, a sort of standards moat. I don't really hear this being talked about too much, but like Google is probably the classic standards moat in the sense that it's become the standard of its industry. Moody's and S&P Global, also phenomenal businesses, they're the standards of their industry. And another like consumer sort of example would be something like Uber. Like when you want to hail a ride, you're going to call an Uber, and it's become verbiage and that type of stuff, right? So I think first it has that portion of things working for it. And then furthermore, if you actually look at the history of the browser wars in the late 90s, early 2000s, you would notice that technological leadership at that time, when it was extremely uncertain and big boom and bust and the early internet days, right? Like if you look at the history of that, we have a real world example of technological leadership does not outright win. In fact, it's the distribution of it. And the example that I gave was that Netscape, which had, I believe, like an 80-90% market share on the turn of 2000, around that time, maybe the late 90s, they had about 90% market share, give or take. They were the superior search engine. And so Microsoft actually kind of viewed it as a existential crisis to their business. And the way they kind of solved it is they just defaulted Internet Explorer, which is now, I believe, called Microsoft Edge or Bing. And so they defaulted Internet Explorer at the time on all the Microsoft ran computers, which happen to be like, I don't know, like 85% of all computers. Like basically anything that isn't Apple had Internet Explorer on it because it ran on Microsoft, and Microsoft also owns Internet Explorer. So the point I'm trying to make with this is it's not necessarily like the real moat in, I guess, software, if you will, the real moat in software, I guess, if you will, it's not necessarily the technological leadership that can easily be messed around with, particularly if there's another cheaper solution that's good enough that gets the job done, but that's a whole other argument. But anyways, the technological leadership of it wasn't what eventually won out Microsoft with Internet Explorer. It was the fact that they already had millions and millions of install points and they had the distribution prior to the search engine. And even though they started later than Netscape, and Netscape was the massive Goliath in the industry, Microsoft with their distribution was able to actually beat Netscape. Now, of course, Google does come along later, and that's a whole nother story, but the point still stands. Technological leadership alone usually doesn't win in software. It's actually the distribution that is the ultimate moat and the ultimate advantage. So in terms of Microsoft with ChatGPT and all that type of stuff, I don't know. I'm not going to speculate on what the next 10 years could look like. But me personally, I'm a very happy shareholder. And to be honest with you, like we would probably see the moat eroding over time with Google many, many years before Google would go to zero, essentially, right? Like we would be able to see this type of thing. Like it's not like an overnight thing of like, oh my God, ChatGPT just took 50% market share. It's over for Google. Like that'll never happen. You'll see it slowly dwindle down over time. And maybe that results in some loss on your investment, but at the end of the day, like you have time to get out. Complaint number 2, and this honestly on first glance probably feels like the more immediate risk with this business. It does in fact have to do with the free cash flows, or I should say the lack of free cash flow growth that comes with Google currently. So you might have seen some tweets floating around by some big name investors saying that Google hasn't been able to grow free cash flow per share for the past 3 years. Rightfully so, the stock has stayed flat for the past 3 years. And on surface level, great narrative. I mean, just a brilliant narrative to try to sell. But the part where certain people kind of focus in way too much on just one metric, which is free cash flows, is these are real businesses. And there's very, very few businesses like MasterCard that are able to generate free cash flows that go up and to the right every single year, every single quarter without fail. It just keeps stepping up just like a ladder up into the corner. There's very few businesses that actually do that. Unless you're some type of like software business, like a SaaS business that obviously you're retaining a lot of your revenues. These are real businesses with real investment cycles, all that type of stuff. And so with Google in particular, you might think, oh, it's pretty capital light. I mean, they're shipping bits across the internet, right? Like, my God, you would be wrong. Google has a massive cloud business. It currently stands at roughly a $50 billion run rate business. I don't know off the top of my head, but that might be like a top 100 business by just revenue in the world. Google Cloud alone, which is like 10% of the revenue, something pretty small currently, right? It's a top 100, Fortune 100 business in the world, right? So massive, massive business. Of course, they're in third place behind Amazon and Microsoft in the cloud computing world of things. But you might notice that particularly in the last, give or take, decade, Google has gone through various different investment cycles. And I highlight the period between 2017 to I'll probably say like Q1-ish of 2019, maybe Q4 of 2018, sorry. In that time period, you would see dwindling cash flows, free cash flows in particular, from Google. And it's pretty common knowledge, I would assume most of you already knew this, but free cash flow is derived by taking cash from operations minus capital expenditures, and I want to put the utmost emphasis on this capital expenditures part of the equation. Frankly, it's a little bit misleading to just look blindly at the free cash flow chart of Google over the past decade and zoom in on the past little, I don't know, call it 12 quarters or so, 10 quarters or so, and say, oh, free cash flow trailing 12 months hasn't moved. Clearly, that must mean that this company isn't growing, therefore the stock deserves to be flat, right? You fail to realize that this is a real business. They don't care about having your little charts on Twitter look nice and all that type of stuff. This is a real business. They're going to go into investment cycles and put money down for future years and excessively put money into capital expenditures, building out new data servers, all that type of stuff, if they see fit that they're going to make a high return on investment for the foreseeable, call it 3, 4, 5 years, whatever the case may be, right? Case in point, between the roughly, I want to say, early 2017 to late 2018 period, again, roughly about 10 quarters or so, continuously, the free cash flow has gone down. Now, if you look on the surface level, you're like, oh my God, this is so horrible. Google as a business, it's diminishing and it's becoming smaller. They're doing less in free cash flow. The stock consequently deserves to go down. There's a fundamental reason, Arya. It must go down. And again, I do really want to hammer this point in. If you look over to the free cash flow chart, it looks like it's dwindling, going down. But in reality, in the 2017 to late 2018 period, it actually grew significantly. It went up, by the looks of it, I want to say about 20% in roughly a 2-year period. I think that is very reasonable growth. Of course, you can't expect these businesses to churn out 15% growth annually perfectly, all that type of stuff. But 10% growth is nothing to laugh at. Coca-Cola would absolutely love that. With that in mind, if we toggle on the free cash flows and look at it in the same period, you could see that again, since Q1 of 2017, it had gone down to a low of Q1 2018, roughly a year after that. And again, you could see that the cash from operations, the operating cash flow, stayed relatively flat to even up by the time that the free cash flow started to actually recover. And so sure, you might not care about 2017, but what about currently? Why are they investing so much into Capex? What's going on with this business? Is this going to continue? As a shareholder, you'd want to know, when do they go back to free cash flow, massive profits mode? And so FinChat has this Copilot feature where you could ask it questions. It's kind of ChatGPT. It's kind of like ChatGPT, which is funny because we're making a video on Google. But anyways, I just straight up asked it. I said, what did Google management say about the excessive Capex recently? And they gave me a bunch of different stuff and when it was said. So as you can see, Ruth Porat, I believe this guy's the CFO, COO, something like that. So he mentioned that they're going to continuously invest aggressively into the cloud business. And additionally, they mentioned that the quarterly Capex is going to be roughly around 12 billion per quarter. So it lands you at just shy of 50 billion for the entire year, which is just a massive amount of Capex. To give you an idea, Amazon, which is a historically very Capex heavy business, at its peak was doing about 65-ish billion dollars of Capex. So 50 is nothing to scoff at, right? And just really goes to show how much money is being spent on these cloud businesses, building out the infrastructure for it, and frankly, how much demand there's going to be in the future, right? And so actually, if we scroll down here towards the bottom, they give us a summary saying Alphabet is making significant investments in its technical infrastructure and cloud business, resulting in elevated Capex levels. The company views these investments as necessary to maintain its technology leadership and capitalize on opportunities in AI and other strategic areas. And then they link us the earnings call at the bottom here. I'm not going to bother reading that. Very, very useful feature, I must add. And so to kind of wrap up the end of this video, I want to just go over the numbers very quickly. I mean, we've done a pretty decent overview of the various different risk factors with this business. We've also gone over the fact that they're currently in a big investment cycle that's kind of muddying up the free cash flow figures and whatnot. But I mean, on a revenue and earnings basis, which I prefer to look at Google specifically on an earnings basis, which I've been critical of in the past, you would see that things are improving exceptionally well. I mean, in the trailing 12 months, as of the last quarter, Google was able to grow their revenues at a 13% clip. This is an acceleration from the quarter prior, roughly just shy of 12%. And it seems like this is trending in the right direction because I would expect this to tick up in the next quarter as well. And then additionally, if you look at the earnings per share, you would see a massive growth by just shy of 50%. I do not expect this to sustain itself. I think this has to do with the fact that we have negative comparables to the year prior. So it just looks excessively good. I think more reasonable, something closer to the analyst expectations. Roughly, I want to say between the 22% to 17% in the next 2 to 5 years. I think that's probably something more reasonable. And it's nothing out of the ordinary for Google because if you look in the past 10, 5, and 3 years, that's roughly the range in which Google was able to grow its earnings per share at, between a mid-teens clip and around a low 20s%. And ladies and gentlemen, I'm going to remind you one more time, the eye-watering price that you have to pay to be able to own shares of this business are currently sitting at a forward PE of 18.5. And actually, if you look on Yahoo Finance, I'm not sure where they get their analyst estimates from, but on Yahoo Finance, it's sitting at a 17 times PE. right? So you're looking at this business, which has a network moat, it has 95% market share in its core business, it has a robust balance sheet, stellar margins, incredible growth profile, and it withholds information access to literal billions of human beings around the world. It has transformed how we live in the past 2 decades on this earth. You could buy shares of this business for an 18 PE. To give you an idea, Ulta Beauty, which is a company we cover on the channel quite a few times, they're trading at a 16 PE ratio. You could pay up to a 17 PE to own like one of the most dominant businesses of all time that is still growing at 20%, or you could buy the retailer Ulta Beauty in the market. And don't tell me it's an unfair comparison, different industries, where like valuation in these businesses, these things have been made to be able to compare the various different investments. $1 earned in Ulta is no different than $1 earned in Google. At current valuations, with the growth profile and the moat that Google has, I feel like it's a no-brainer. Especially at a time when the trailing PE ratio of the S&P 500 is sitting at 28, Google starting to look like a bargain. I would never directly endorse or tell you to go out and buy shares, but I mean, if you're not pulling the trigger on Google at these prices, at a historically low valuation, with seemingly nothing really wrong with the business, like at the lawsuit thing, we didn't cover that, but I mean, that's just going to come and pass. You saw earlier in the year, they had the AI demos that went horribly wrong. I'm not denying that, but I mean that just came and passed, right? Like the stock sold off because of that, because the uncertainty, whatever, blah blah blah. But it came and went, right? I think the same thing about the lawsuit earlier this year in April. I want to say with Apple, they were getting fined by the European Union. The DOJ was pressing them about some monopoly thing with the App Store and all that type of stuff, right? They were getting like $1 billion fine. Stock went down to 165. It's at like 230 now, right? Like these things, they just come and go. I think it's cheap. I'm personally buying shares. My next paycheck that comes in, I'm probably going to buy more shares. And actually, I already tweeted about this, but I'll mention it on the YouTube here as well. I'm honestly thinking of axing Uber. You could go back in the video where I did buy Uber. The moment at which I bought it, I literally said, there's a watcher position. There's zero guarantee this is going to be in the portfolio like a month from today. This was a watcher position this whole time. I've literally made like a very insignificant amount of money, like 2% on a 2% holding. Like it's completely nothing. So honestly, I'm just thinking of making that tiny little piece of the portfolio a bigger portion of Google, which sits at just shy of 17%. So I think with that 2%, it would be around 19% of the portfolio, right? So anyways, that's what I'm thinking of doing with that. Also, we've been using FinChat the entirety of this video. If you use my link in the description, you'll get 2 weeks of full functionality completely for free. You don't have to put any payment information in or anything like that. Thank you for watching and have a great day.